Hello, YouTube. Is it finally over? Are we going to get more downside or a massive collapse? Jerome Powell seems to be pushing us to the edge of the cliff, and maybe we're going to fall over. We're resting right on the 200 DMA, and an article from August tells us that a week of 1% moves on the S&P could trigger forced selling. Well, if we look here to our chart, we note that over the last 2-3 weeks, we've had nearly a 1% move every single day. And this is at a time when we're resting on what should be strong support, or the 200-day moving average at about 419. So if we continue to see big moves and it's going to lose that 200-day moving average, that could trigger even more forced selling, which would mean that the red you see right now, whether it's on the 1 day or the 1 week, it's going to get even more bloody. And we're here into extreme fear like we were a year ago. As a reminder, that was actually when we formed our yearly bottom, right? Our 52-week low. We were at 16. We went to 16, and then we finally got that relief. But I think a lot of this is different this year, as we will talk about the bear case today, because of Moody's. And I think this really comes down to the fact that it appears like we're right on the edge of falling over the cliff. Why? Let's see what Moody's told us. Moody's on the shutdown. While government debt service payments would not be impacted and a short-lived shutdown would be unlikely to disrupt the economy, it would underscore the weakness of U.S. institutional and governance strength relative to other AAA-rated sovereigns that we have highlighted in recent years. What does that mean? Well, we avoided the government shutdown, but we're seeing something that's not happened in 113 years, since 1910. House begins vote on motion to remove McCarthy as a speaker. So institutional and government strength, well, this doesn't look good. It does not at all. And we also see pressure being added because there is $7.6 trillion in U.S. government debt that will mature in the next year. This was a month ago, while rates have gone a lot higher. And what? They've added pressure on rates. So $7 trillion and $2 trillion in corporate debt wall will spark job losses going into 2024 per Goldman Sachs. So this all looks really bad. So note the last part of this headline, job losses in 2024. Well, right now the market tanked because we have so many job openings, nearly a million extra. So the market is really strong right now. We can note that we have 9.6 million jobs currently open with 8.8 million forecasted. That's a big beat. So it looks like Jerome might actually be late to the party again. So it looks like what's going to happen is we're going to get right to the edge of that cliff. We might even get pushed over. And then we're going to find out whether or not 2024 is going to be terrible. So we got a lot to go through today. But I'm going to ask you for a huge favor before we go further. If you could please consider smashing that thumbs up and subscribing to the channel, I would really, really, really appreciate that. And thank you for your support ahead of time. Let's go forward. So if you think about everything that's happening right now, I think that Jerome he's got a job that I don't think a lot of people envy. And I think that right now we want to be mindful of what this can mean for our portfolios because we want to know where we're going to go from here. So let me get through some of this news to just see exactly what I had laid out. And there's actually 4 reasons why we could be going lower into this month. So what could go wrong with the government shutdown? Well, a 0.5% loss of GDP per week, which could mean that we could go into recession pretty easily just based on that. Then we talked about the Moody's downgrade. And then all this government data, which is not going to be impacted now. But U.S. spending is like on a trajectory which is currently not sustainable. And the fact that we're seeing Kevin McCarthy trying to get removed as Speaker of the House, I would be on edge if I was Moody's. So we definitely see extreme fear, but we're still here at about 420. So like it's pretty surprising, to be honest. We were at about 380 in October of last year. And that was really the bottom. Seasonally, that's really when the bottom is formed as well. But this time might be different, as I'm sure people in the comments are going to tell me today. So why a US recession is still likely and coming soon? Well, now we're getting even more evidence, but notably this one here is really sticking out to me. Soft landing hopes and hard landing realities. Optimism tends to peak before a downturn hits. Well, we're currently in the middle of a downturn, so look at this, right? Soft landing hits an all-time high, then we get the recession. Soft landing discussion, recession. Soft landing, recession. Well, we hit a new all-time high here. So this does not look good. Also looking here to unemployment, which could risk skewing heavily to the upside. And that's what we just looked at with that Goldman Sachs report. Oil and treasuries are also surging, which is going to add pressure to stocks and to everything. So a lot of people are basically looking for the Fed to actually pivot now. Well, the Fed usually only pivots when something breaks, which is why we see the biggest declines after the pivot. Negative 36, 48, 27, 51, 58, and 35. So we don't actually want to see the Fed pivot. We just want to see them pause. And we have a lot more speakers coming up this week. So tomorrow is going to be Wednesday. So we're going to have ISM, ADP, notably ADP for me, I'm going to be paying attention to that because it will be a preview for Friday. We got PMIs, durable goods. We got Bowman and Goolsby speaking. Then we got more Fed heads talking on Thursday and another one on Friday. So we got a lot to go through. And this is coming at a time when we're seeing record selling. This is the Strategic Petroleum Reserve, or the SPR, is now at its lowest level on record. Only 17 days right now. So that's not good at all. And oil prices are not going down. Not only that, the U.S. bond market is now in its worst drawdown of 38 months and doesn't look like it wants to stop. So this is looking really, really, really ominous. It's a very bad omen. And what really drove the market today is that we're seeing a lot of things really bubble up and create fear, right? We're in extreme fear right now. Don't get it twisted. So extreme fear is usually where we bottom. But if this time's different, it's 2008, then we can't really rely on that. So nearly another million jobs added. Just shows us how strong the U.S. economy is. And that's why we're seeing rates go higher. They're going higher because we're expecting it's going to be good. U.S. GDP for the third quarter is also expected at 4.86%. And that's pretty high. So the fact that it's so high, it really tells us that, man, this U.S. market just seems like so strong. It doesn't seem like it wants to stop, right? Can't stop, won't stop. So I mentioned a few things about tomorrow. So I've been saying I'm bullish. I'm going to talk about my update at the very end of the video, so make sure you stay tuned for that. But here's what I'm watching for tomorrow, because the market's moving fast, and we're talking about Jerome Powell ending the stock market and finally collapsing it. Well, tomorrow is where I'm going to be looking for more data. So we got a surprise shock today to JOLTS job openings, while on Thursday we're going to get initial jobless claims, which will either confirm or deny the strength of job openings versus people actually losing their job. But then the other thing I'm going to be looking for is going to be ADP non-farm payroll. Huge asterisk beside this one because ADP has not been very reliable lately, but I got a feeling with the market in extreme fear on edge, it might tip it over the edge tomorrow. Might also be the relief we're finally going to get. So we're looking for less jobs added. We're looking for a reduction in PMI. We're looking for a reduction in PMIs as well, like the ISM. And that would be constructive because we're finally cooling off. Well, if we're cooling off a little bit, are we going to cool off a lot? That's the part I don't know. But the ADP non-farm payroll will be a preview for what could come on Friday, where we're going to have non-farm payroll from the government and then the unemployment rate. That's really what it comes down to. So if now we look over to the charts and we want to understand the strength of what is actually happening out there, well, take your pick. It's pretty red. So the S&P, we're just going to go through a couple of charts really fast. S&P right now, it's down by 1.3%, resting on its 200-day moving average. Volume is also elevated. QQQ holding up a whole bunch better. It's right around last month's low at 354.71, currently a failed breakdown. We can see that here by looking at the monthly chart. So we have an inside bar and back above the August low by a few cents, but not by a lot. The dollar is starting to advance even more. The VIX is starting to boom. It's up by 12%, approaching 20. The 2-year note is up here at 5.15. We know the 10-year note, which is really the one that gets me the most concerned here. Oh my God, I do not like this. Why? Well, the crash signal that you worked in March of 2022, that worked in in January of 2018. Well, it was this crash signal, and we got another W or another win, and it's been relentless. In the last couple of weeks, we're up by 20% on the 10-year bond, which means that we're really seeing a lot of stocks finally start to get hit massively. And the reason why this matters is for a few reasons. So the first reason why it matters is because normally there's an inverse correlation between the NASDAQ, which is the red line, and the black line, or the 10-year note we just looked at. This data is about a month old now, but it shows us here that they were both going higher, while rates are going even higher, and now tech is finally taking a dive, finally moving lower. And the reason why this is concerning for me is because the big five the Magnificent Five, Magnificent Seven, whatever you like to call it, going into this next earnings season, part of the issue is that right now, we can note that their revenue and profit are currently declining, but trying to curl back up into positive territory. And this is going to really set the tone for this next earnings season. And if we look forward here to part of why this could really turn into some forced selling, well, we note that over 80% of funds that reported since June are overweight Amazon, Microsoft, and NVIDIA. Who are the biggest decliners today? Well, let's look over here at the heat map. NVIDIA, Amazon, and Microsoft. Oh, crap, right? That doesn't look good. This doesn't look good at all. No, it doesn't. So the reason why I'm a little bit anxious is just because this could really start to cascade and get really bad. If you look at the biggest decliners, let's just go no group. Oh man, it's those three blocks: Microsoft, Amazon, Nvidia. Yes. So it looks like forced selling is starting. So if forced selling is starting, that's going to be evident here on the 1-day chart, like we just went through. And what I want to do now is actually go to our below 50 DMA club to see who is actually above or below. And we're going to be looking for two lines. The blue line is going to be the 50-day moving average, and the black line is going to be the 200-day moving average. So 50 and 200. Sorry, I think I might have misspoke there. So we look here to the S&P. It's below the 50, resting on the 200, weak. NASDAQ holding up, but it's at risk of falling. Volume's elevated. We look at SMH. It looks just like QQQ, resting right around the August low here. We look to NVIDIA, rejecting, trying to make a move back above the 50 DMA. Had some positive news today, but could not hold on to gains. Bearish engulfing daily candle. Apple holding up right around that August low as well. We look here to Tesla. Tesla's holding up, trying to digest that 50-day moving average. And we note a bullish pattern inside of here. We're an inverse head and shoulders. If we look forward here to FXI, it's below both. We got a death cross, which means the 50 is now crossed below the black line, and we're below both averages. China's weak, negative 2% today. Microsoft looks just like the other ones, resting around that August low. We move forward here to ARK. Man, it's in the dumps, right? Way below the 50, way below the 200, rejecting off of it in the last few days. This doesn't look good. We move forward here to the DAX. It's below both. It's below the blue and the black line. Cool. Now we look here to XIU because we're also below this one as well. This is going to be Canada. So this one here is not good because it means the rest of the world is there. Death cross forming here on emerging markets. We can see that here by the blue line crossing below the black line. And we're way below. So it's the whole world selling off. This is starting to really accelerate. Look at the Nikkei today. Woof! Negative 3%. Wow. I was looking at this today. USD, JGB. Man, massive move. And the Nikkei is down by nearly 3%. That's likely going to create some overnight selling into the Asian market. That's my suspicion here. So as we're looking forward here, we note that, man, it's really getting bad. Ether resting on its 50-day moving average after having that spot ETF for the futures launched. And whoa, right? This is not looking healthy at all. Bitcoin stuck. Already had the death cross, and it's not looking good here. So everything looks pretty soft. And the reason why I'm really starting to feel the pressure is because we're into extreme fear. So it's very normal. You feel fear when we're in extreme fear. I mentioned before that we sell greed, which happened a month ago. We buy fear. The problem is that we don't know where the fear is going to wash out or bottom. So if you buy fear, do you sell extreme fear? If you went all in into fear, do you have any ammo left in your chamber? If you don't, this is very, very concerning. So what I want to do now is leave you with a little bit of hope, like I mentioned at the onset of the video. So what I'm really watching for right now is a very specific pattern which can give us a little bit of hope. Hope just means that we could go higher. That does not mean we need to. But before we do that, I'm just going to ask you one more time for a huge favor. If you could please consider smashing that thumbs up and subscribing to the channel, I would really, really appreciate that. So as we move forward to the last part here, this is where U.S. stocks are headed after the worst month on record, which is September. And we look to the stats. On average, 62% of the time we're higher. So the caveat here is that if it's 2008, man, this could be a negative 17% month. So we look here to the numbers. Pause the slide if you want to see it. On average, we're up by 2% for the month. So when I look here to the S&P, yes, we've stopped going up. We can see that clearly here on the daily chart because we've lost the green line. If we move here to the weekly chart, we note that we're currently below last week's low at 422.29. That's not good. We got lower highs, lower lows, and the crash is starting. The target that I had for a negative 10% drop, which people made fun of me for saying before, is here at 413. Well, we're pretty close to it now. We only have to drop by an additional roughly 1.5%, and we're 10% off the high, or we're officially in correction territory. But here's what's really important, because when we look here to, let's actually pop over here to SPX, and I want to go to my fourth board. So I have this template laid out here that hopefully you're going to appreciate. It's what we went through on the weekend. And what it shows us here is those stats that I shared on Twitter. And what this really shows us is this pattern here called the failed breakdown. So what I want you to look at right now are the yellow boxes. I'm going to delete everything, and then we're going to find out exactly what a failed breakdown is. So a failed breakdown means that we break down, meaning we print a lower low, we break down, or we print a lower low, we break down or print a lower low, but then we fail to hold it. So all that means is that we break the low, but then we rally back up and close above it. Here it's a bullish engulfing candle. Here it's an 8% month. I don't know if this is going to happen this time, but hey, if it does, I'll be very receptive to it. So I'll tell you exactly what my cheat code is. Normally, I would not share this, but I feel like people out there are really starting to feel anxious, a little bit concerned. So I want to see us back above 433.01 on S&P, meaning SPY. We're looking at SPX. For me to know that we at least have a weekly candle close above that key area. Otherwise, the slide is starting. So that's what I'm watching for specifically. And what that also means is that I might have to wait and look like I'm stupid because right now we're bearish. We're below the previous monthly low. It might be 2008. I might be eating some humble pie. I might really regret the words I'm saying right now, but I'm on team risk reward. And I'll tell you the final reasons why I am bullish. And it's not a terribly complicated story. So the complicated story for me is just that we have to be patient. PAYTIENCE. So let me just see if I can pull up this last tweet here. Here we go. So if you want to follow me, I shared a lot of the stuff. My handle's in the description in the top comment. But on average, when we're red, again, on average, I'm not saying this is the Justin guarantee, 30-day money back guarantee. We're going to go up by 8.7%. But on average, when we're down in August and September, we rally by 8.7% in the final month. I just showed you the pattern on how we could rally up by multiple percent in a single month. And seasonally, after we have a weak September, we go up. We don't buy fear. Sorry, we don't sell fear. We buy it. And now we're in extreme fear, which means we should be very receptive to it. But the final part about this too is that just like a year ago, we go from extreme fear, back into neutral, back into greed, which means we want to see higher highs getting formed. The chart's forming lower lows. That's why we're all the way down here into extreme fear. We want to see higher highs get formed in fear and greed, or get back into fear, back into neutral, back into greed. And we got to see that same thing happening here on the chart. Those are two of the key things I'm looking for. But then also I'm looking for algos, which is proprietary, a tool that I created. You can find out more at thealgo.com, or just wait till the end of the video. And we note that we have our worst since indicator. Well, the worst since is usually followed by the best since. What would that mean? Best since. This is October of 22 and October of 21. And then the final thing we're looking at here is that government shutdowns are a buy the dip. But the huge caveat here is that this also assumes we're not going to get another downgrade from Moody's. So a lot of information to digest this weekend. If you want to see my thesis, I encourage you to click on the video now queued up here on the left-hand side. If not, what you can do is you can actually come trade with me, Justin from YouTube, and you can go to our website, thealgo.com, to see exactly what I'm going to be doing. And for the next 14 days, it might be worthwhile to see exactly what I'm doing in my account, because I have more than one way I like to trade. I like to swing. I like to invest. I like to do tactical trades. And if you're wondering exactly what we do after we sign off YouTube with all these notes, I would encourage you to go to our website. Come hang out for 2 free weeks. If you don't like it, quit, leave, don't get charged. No problem. Go back and watch on YouTube for free. But with the market currently collapsing, it might be a great time for you to come join us. With that said, thank you so much for tuning in. I look forward to seeing you tomorrow. Thank you again.